It's a mixed bag, but Shanghai continues to belabor with 3.5% in terms of red tick, and Nikkei as well, down about 1%. What's this red paint that we see across equity markets? Let's put that to an expert. Jeffrey Dennis of UBS is joining us on the phone line from Boston. Good evening to you, Jeff. Thank you very much for staying up for us. It's 5 days of consecutive fall in the US markets, but it's 5 days of consecutive fall for actually global equity markets. What is this fresh scare? Are there any fresh deflation worries?
I think it's a combination of factors. I think the most important thing that's hurt the markets recently is ongoing concerns about China, which of course were reflected in an enormous decline on Monday in the Chinese local market. But at the same time, as there's been these worries over China, including of course worries over the economy, you've seen this breakdown in commodity prices. So I think that those are the two factors that are related here, because the fear with commodity prices being very weak, despite the fact the dollar itself has not really risen over the last few days, I think that's causing investors to be concerned about the Chinese economy and also, therefore, perhaps about the global economy overall. That's how we read this latest sell-off we're getting.
Okay. Jeff, hi, morning. Do you expect this wave of risk aversion in global equities to continue because of the reasons you alluded to?
No, I don't think it is going to continue for much longer. I mean, clearly, I'm not in the business of trying to forecast things on a daily basis, but we do think that the concerns have got somewhat overdone. For a start, we certainly think the Chinese economy is going to continue to grow. It's somewhere around 6.8% this year, 6.5% this year. So we don't really think the decline in the Chinese market has got much to do with the economy itself. I think it's more of a market-related factor. Also, I think investors are getting, obviously, a little bit nervous about the Federal Reserve, and yet one's got to presume that the Fed, it's well understood the Fed will begin to tighten policy sometime later this year. So we wonder whether things are getting a little bit overdone, because we're not that concerned about the global economy. We think the global economy is in reasonably decent shape.
Okay. So, Jeff, what are you expecting from the FOMC, and how might the markets react to the various scenarios?
I think what everyone's watching from the FOMC this week is do you get a clear signal from the markets that they are likely to raise rates in September? The UBS view is that they will raise rates in September, so I guess that signal is entirely possible. I suspect that if you do get that firm signal they're going to move in September, I think the markets could sell off a little bit further on that, although not a great deal. On the contrary, I think if the Fed continues to be in the current mode that it's in, watching the data, talking about higher rates, but not being very specific about timing, I think the markets may rally, because if you get some sense the Fed may be pushed back until around the end of the year, the markets would probably like to see that happen. But that is not our view. Our view is we're going to have a signal here on Thursday about September, and that could give us another modest sell-off in that event.
Okay, so just one final question before we let you go. Since you did say that the market concerns on the global growth seem to be overdone at this point, is this a good time to be increasing your allocation in global equities? And if yes, what would your own pecking order be?
Yes, I mean, obviously I cover emerging markets, and while, as I say, I don't really think it's easy to pick this on a daily basis, emerging markets have come all the way back now to being about fair value, even slightly lower than fair value. We are beginning to see some evidence that earnings growth is beginning to pick up in certain areas of the emerging markets. You're getting some margin expansion, which is probably coming from the impact of lower oil prices. And if these concerns about the global economy are overdone, I think this is probably a pretty good time on a 6 to 12 month view to be looking to add to emerging markets. We're still overweight in China, which we think is a cheap market in terms of the H-share market, the MSCI China market as well. We continue to like your market in India because of what's going on there. And we also have overweights in places like Russia, where we've made a bet that the oil price is somewhere near the bottom, although it's not working out that well at the moment. But we don't think oil is going to be that much weaker from here. We also have an overweight in Mexico.
All right. Thank you very much. So that's the pecking order: China, India, Russia and Mexico. Thank you very much, Jeffrey Dennis, for joining in. All right. So at least the fear is, the expectation is that we are somewhere at the bottom.
Yes.
If it is in terms of crude prices, then I would assume that even in terms of growth fears, we are somewhere
You know,
at the
it's
bottom.
very interesting, and this is something we observed yesterday as well. People who are sitting closer to the Chinese and the Singapore markets are not as concerned as people who are sitting far away. I guess that's how the nature of
Chinese
this market is.
Clearly, the fall is more related to the Chinese stock market issues.
Yes.
It's not reflective of the economy. It's because it also had 150 PEs, PE multiples and 100 PE multiples some time back. And the margin funding clampdown resulted in that market deflating. It was not economy related. So we should be able to distinguish the two. The fear only is if the wealth effect goes in China, will that start impacting consumption? And the verdict, at least as of now from the China experts, appears to be that it's a very small part, the Chinese wealth effect, and therefore consumption need not necessarily be impacted because of what's going on in the stock market. Well,